All right. Good morning, everybody. It's Friday. So the banks reported this morning. That's the first thing giving us impact. We had CPI yesterday and Bank of Japan intervention, coordinated timing at the same time yesterday. They still deny it, but there's been a lot of reports, and they always deny, and then they can't hide the funds. So when they finally have to publish their funds, they'll say, "Oh yeah, we intervened." They did it on a Japan holiday as well. You look at Finance Juice. Monday is going to be a holiday in Japan. So green on the screen, small caps are up the most. They're the ones that are perceived to benefit the most from the moves that we've seen in the dollar and the yields. NASDAQ basically flat, then Japan, S&P, and the Dow really close to flat. Europe up slightly. I believe by the time we get into lunch, we'll be done for the day. We really won't have um, any extraneous impact coming in the afternoon. So by the time we're done with lunch, any sort of 0-day play that you're going to have should solely be whatever you have in the charts. There shouldn't be any sort of econ in the afternoon today that'll mess things up. Yesterday, between the 30-year at 1 o'clock and then that budget announcement that came out at 2 o'clock, there was just all these late afternoon impacts that could change the trajectory of the market, and it just makes 0-day plays really dangerous. But today, at least the afternoon session will be free and clear. Just remember, next week is OPEX. The third Friday of the month is always options expiration. Two of the biggest banks, one of the biggest things that people were looking at were net interest income and investment banking revenues. Kind of scroll back, didn't seem like they hit their target for one of these. Let's see, JP Morgan net interest income 22.86 billion, and it was estimated to be 22.82. So it came in a little above, but they still see fiscal year net interest income at 91 billion, and it was estimated at 91.38 or 33. So just a little shy. And then for Wells Fargo, 11.92, and it was estimated at 12.12. So a little short on that. The central pivot ranges are overlapping. It's also lower today than it was yesterday. Takes into account the drop that we had. You can see the move ran all the way down to Wednesday's low. It's where we found stability. It's a basic pivot point. Previous days high, previous days low, Globex high, Globex low. We get questions, from time to time. Newer traders will ask something like, what's Globex? And if you Google it, it doesn't come up as how we use it, right? It's just one of those weird phrases. The trading hours from 4 until 9:30, or anything not within the regular trading hours, RTH, anything not inside of that is what we call Globex. Now, if it was stocks, we would just say it was after hours, or we would say it was pre-market. And a lot of stocks, they don't run all night. SPY runs all night. So SPY would fit into the category of something that has a Globex. It's a 24-hour-a-day product. And we know that it's a 24-hour-a-day product because if you look at watch lists on Thinkorswim, it'll show you that it's a 24-hour-a-day product, right? If we just come in here and create a watch list, something like the Qs, see this little 24 tag, or SPY, it's got a 24 next to it that tells you that it's a 24-hour-a-day product. But if you put in something like Google, there's no 24 tag. It's not open 24 hours a day. So if we did look at something like Google, it doesn't really carry that same classification as a Globex. Sure, it has after hours and pre-market trading, but it isn't a continuous thing. It stops around 8 o'clock at night and it starts again at 4 in the morning. So we don't really refer to Globex when we're talking about equities. We just refer to after hours and pre-market. But if you're talking about a 24-hour-a-day product, SPY, the Qs, but mostly on the futures is where we use that language, then Globex is anything that isn't regular trading hours. It's the overnight hours. Generally starts at 6 p.m. after settlement, and it runs until 5 o'clock p.m. when settlement begins again. That 1 hour between 5 and 6 is the only time that it's closed, Monday through Friday, Sunday through Friday, Sunday night. Right? I mean, it's a fair question because, if you're new to all of this, then when you hear me say Globex, you probably have no idea what the heck I'm talking about. Always better to ask. So yesterday we talked about how far price was from the weekly pivot point, and I expressed my concern that we were about as far away as we were going to get and that we would likely top out. I wasn't necessarily expecting a sell-off down to yesterday's low, but I was pretty confident in the idea, especially after we got the gap up, that we were looking at a gap close play, and it just kept on going to the downside. Remember our discussion yesterday that we were looking for a gap up or a gap down, a single bar moving in one direction without a lot of moves in the other direction. There's a couple of things that I didn't like. The wick is really small, so it behaved well. It did push, and it closed in the upper portion. So if we wanted to, measure this one bar and say, did it close greater than 50%? Did it close greater than 75%? We'll just put a 78, but 75 would be the number we would want, right? Did it close better than that? And it did. It closed in the upper portion. Fine. Everything was great. The thing is, these gap close plays, they should take hours. It's supposed to get back down to the bottom here about 10:30, 11 o'clock. It got back down there really fast. I traded it. I'm sure reading the chat, I've seen a lot of people traded it. It's great, right? At least you weren't trying to buy the highs. But when it comes to gap close plays, this isn't what we want. We don't want it to close the gap that fast. I don't even like trading in this time frame between 8 in the morning and say 9:45, 10 o'clock in the morning. I don't like that 2-hour window. I don't generally trade there. So I did it. Why not? It makes money while there's time to make money. But this is not going to go into the books as a good gap close play. And in fact, it's probably going to get added to the books as an example of what we don't want to see. It was tradable though, especially once it broke through this halfback level. That's when it really accelerated in that last 5 minutes just to get back down to where it started. And it did get right back to where it started to the tick. Right? I'm using the bottom of this candle, but if I used the open of this candle, that's exactly where it went. So cheers for that, right? Get it while we can get it. But the market really accelerated to the downside after that. And we had some good plays. Stopped on a strategic pivot point, just like it should. The afternoon 0-day yesterday was just too dangerous, so I didn't put it on. The reason I say that is because we had all those extra events. If it was a day like today and we had already reached such a strategic pivot point, I probably would have done a 0-day in the afternoon. But we had 2 o'clock data and 1 o'clock data, and it was just too much of a threat. And I'm not willing to do that. Now, putting on something cheap like a lottery ticket, why not? Right? It's a lottery ticket. I will risk 1 or 2 pennies to make 90 pennies. Right? For you that don't trade options, that means I'm willing to risk $1 or $2, just like a scratch lottery ticket at the gas station is $2 for a chance to make $90. Heck yeah, why not? But I'm not willing to risk, say, $2,500 for a chance to make $1,500, $1,800 because there was just too many economic events in the afternoon yesterday for me to be comfortable risking a couple grand there. So I didn't. Today, however, the afternoon is free and clear. If we happen to make such an exaggerated move to a strategic pivot point like we did yesterday, well, it's game on. So the pivots are overlapping, and it's lower today than yesterday, and it's a very wide channel. Generally, when we have really wide channels, we don't expect breakouts to stick, and we don't expect to make big exaggerated moves. Yesterday is a classic example of a really wide pivot. We shouldn't see the kind of moves that we saw yesterday on a day when we have this wide of a channel. We also had BOJ intervention. The Bank of Japan intervened yesterday strategically, coordinated intervention. Generally, when we get that sort of intervention, we get a really big move to the upside in the S&P and the NASDAQ. No, that's absolutely not what we got yesterday. So there's, some odd impact to the moves that we saw. But if you looked around, and one of the searches that I kept looking at yesterday is things that were near their 52-week low, everything was green on my scan for stocks near their 52-week low. They were all green. And when I ran a scan for stocks near their 52-week highs, they were all red. So it's like a very obvious kind of rotation going on there. Will it stick? We'll see, right? Banks, I haven't had a chance to digest everything yet, but if we hear from the banks on their forward guidance that they're worried, and that's going to have a big impact, right? Banks set the tone for earnings, and their forward outlook is as impactful to the market as an FOMC is. It sounds silly, right? Like Jamie Dimon and those guys, but their words have weight. So we really want to hear what the banks have to say and listen closely to their forward guidance, not because we want to follow them. Never that. They'll try to play their book and just sell you what they want to unload. But we want to hear their outlook. By Monday, we should have a clearer picture on that front. And then next week, we're going to get a lot more bank earnings, and that'll help. I point this out today with the move in US dollar Japan and the move in the S&P and the NASDAQ. This isn't how it's supposed to go, right? When you get that sort of intervention and that sort of move in US dollar Japan, we should have seen a move up in the S&P and the NASDAQ. That's just the way it is. And that is just not what happened, right? So it's a warning of caution. Sometimes our tools just don't work the way we expect them to. They're not picking up on things like we would expect them to. Take this move down in the S&P yesterday and look at the tick from yesterday. This is yesterday's tick. Now, generally, when we're looking at the tick, I ask a very simple question. Are we more in the green or are we more in the red? This is how much time we spent in the red yesterday. There's no minus 500 print, 750, minus 1,000, none of that, not once. And yet, look at the sell-off we had in the ES yesterday. Where's the negative print? Why isn't it working? Well, this is the New York Stock Exchange TICK, right? Just use the dollar sign and type in TICK, and you'll see it's the New York Stock Exchange tick. The ES is the S&P 500 futures. What did the New York Stock Exchange do yesterday? Right? The NYSE. Yeah, it went up very nicely, by the way. This is the New York Stock Exchange yesterday. So the New York Stock Exchange went up. This is the Russell yesterday. Small caps went up. So the tick that we normally look at was positive all day yesterday. Sure, little dips to the red, but we would see that even if the S&P had made, a rally day, there'd still be little dips into the red. But we mostly stayed in the green in the ticks yesterday. This is what can really screw traders up. This is one of the tools that I look at every day. So this is saying that the move down is going to stop, that we're not bearish, that look for reversals, look for longs, look for a flip point, a V bottom, all of that. Of course, we didn't get it. The weighted AD, on the other hand, was very negative, and it got below 250 and it held below 250 all day. This was a very nice contrarian indicator. It was the opposite of what the ticks were doing, which told me don't trust the ticks, which, I mean, the ES and the NASDAQ were falling, so it wasn't hard to figure out that we didn't want to go long. But there was a disagreement between these two, and one quick glance at what the New York Stock Exchange was doing, and it wasn't hard to figure out why the ticks were green, but the S&P and the NASDAQ were red. So when the tools aren't working the way that we expect them to work, try to figure out why, and or just leave them alone and use something else. Yesterday was one of those days where you wouldn't wanted to use that. This is cumulative tick. And the zero line is way down here. It was above zero, expanding nicely to the upside. The green line riding right in the middle, just a perfect, beautiful fork after the green line led them higher in the first place before crossing over and getting into the middle. This is textbook perfect. It's exactly what you would expect to find if we were having a rally in the S&P and the NASDAQ, one of those days. In fact, on a good bullish day where we just expand and expand and expand, you know, one of those days, this is the kind of cumulative tick that I would expect to see. That's not the kind of day we had yesterday. So I'm pointing all this out as a warning. Sometimes these tools just are ineffective. Things like the heavy concentration in the Mag 7 can screw these things up, especially if you're looking at advanced decline ratios. And things like small caps and, you know, the New York Stock Exchange going up while the S&P and the NASDAQ is going down, that can screw things up. And it just makes these tools ineffective. Another really good tell yesterday was the FANGs just, you know, really ripping to the downside, matching the moves that we saw on the S&P and the NASDAQ. Because if the Mag 7 is down, the S&P and the NASDAQ are down, right? There's this phrase, it's not my phrase. I wish I could take credit for it, but it's not mine. If they won't own Apple or put whatever you want there, Tesla, Microsoft, Amazon, Google, if they won't own that, why would they own anything else, right? You think they're going to dump their Google to go buy some trash solar company? Nah, that's not happening, right? So when the Mag 7 is down, everything's down. Except everything wasn't down yesterday, right? We had small caps resurgence and the New York Stock Exchange popping up nice. So we want to be careful today with the same thing. Notice the banks did really good yesterday, riding above that VWAP, striving for new highs, and the NY FANG breaking new lows looks a lot like the S&P and the NASDAQ, right? The advancing versus the declining issues was positive, oddly enough. It stayed above zero. Zero's all the way down here. For the NASDAQ, just barely, but stayed above zero. We could see these shenanigans again today. Just keep your eye out. Be mindful that the tools may be a little ineffective in this environment. Keep your eye on the dollar and the yields. We already mentioned how they made big moves yesterday. They don't have to continue those big moves, but we don't want to see them mean revert with velocity either. Meaning we don't want the 10-year and the dollar trying to pop back up like a bobber in the water. We did get under S1 yesterday. Generally, the SNR 1 wouldn't act as like a resistance level by itself. 2, right? R2, S2, that generally acts as a resistance. 1, at least in the textbooks, it rarely ever will point to an SNR 1 as a resistance level. But when it's a really wide range like we had yesterday, then that S1 is like the distance of an S2 on some of these more narrow days. Does that matter? I mean, I don't, if we could run the stats on really wide days where we had these really wide pivots, and how often an S1 acted as a resistance level, or R1, right? It want S and R as a support and resistance level, as opposed to a narrow one, and what the stats are. I don't know the stats on it, but it would make sense to me because of how wide it was. And for the person who asked about that, you're spot on, right? You nailed it, because it did act really well as a resistance and stopped us from really coming back up again. Just like R1 was the target on the upside move where we stalled out and quit going higher. That wasn't just R1 though. That was also the ADR level. So if we look at yesterday's move and we put the ADR on there, That's a double resistance. We had R1 and the ADR half. And of course, we hit it and it just shut everything down right there. That's where my short was. We do have a market maker move again this morning. And we have a little bit of light volume. I'd say it's not as light as I would have expected it to be. So they are trading it, but they are hedging this morning. We can see that in the market maker move. So we want to keep our eye on that, see if it continues to expand through the morning. That could warn us that there's something out there this afternoon. If you notice, SPY had a market maker move on it, even yesterday afternoon. So it could be that there's still something this afternoon that's lingering. And so if the market maker move doesn't go away and continues to grow, let that be a warning, right? Because these are time sensitive indicators. This is for today only. As the day goes on, it's closer and closer to the end of the day. This should drop lower and lower and lower, and then finally just disappear off the screen. If it stays there and or grows higher, then we're getting closer to some event this afternoon. There's nothing on the books this afternoon, which is why it would be a really great warning. Heads up, there's something out there. If you don't have that indicator, just go to your product, say, the market maker move on SPY or the market maker move on the ES, and look at the expiring options for today. The reason that there is a market maker move is because these front expiring options here are greater in their average implied volatility than these options one expiration away. It's not supposed to be that way. So when the front one is greater, we get that market maker move. You don't need Thinkorswim to see this. Any platform that has the implied volatility average, Fidelity, Tasty, Schwab, Thinkorswim, I mean, it's a pretty common thing. If it has this average implied volatility, then you can just look at the front expiring options and the next series out. And if the front is bigger, then there's a market maker move. That's how we know they're hedging, right? Thinkorswim made an update where you could see the options chain on the charts. It's not really much different than what we had, where you could see the stock charts here in the options chain. They just flipped it around to where now you can see the options chain on the chart, but it's bogged down the Thinkorswim considerably. I built out a lot of charts yesterday, and here I am this morning turning all of them off again because it is just causing all sorts of lag. This is a very tight range this morning. There's a little bit of a threat to this. Got two opinions on it. Let's kind of just work through it one spot at a time. One, let's finish with these pivot points. If you thought yesterday's range was big when it comes to these pivot points, look at today's range, right? So here's before the big range that we had. This was a pretty good size pivot, or a pretty common day of pivots. And you could see how it got smaller and smaller and smaller from this day, right? So that was a big day Monday, and then it got smaller on Tuesday, and then it got smaller again on Wednesday, right? And then we had yesterday. And we talked about how that was a pretty big range yesterday. Well, now you got today. It's a very big range. So keep that in mind. The S and R level, R1 and S1, if we get beyond them, they will act as a support or resistance. So S1 is support until we break it and it's no longer support. It is going to be resistance today, just like it was yesterday. And the same thing with the R1. R1 is going to be resistance until we get above it. If we get above it, it'll very likely act as a support level. You see how the pivots respond around that R1 and S1 levels. I mean, it's worth knowing where they're at, right? We wouldn't treat it as a line in the sand. It's not a stop sign. We don't expect price to go there and stop on a dime, but we do expect price to react at that level. And I would say it certainly proves itself just looking back at how often price does respond at those levels, at least the first time. That's worth noting. Now, you'll always find an example where price just runs right through them and never slowed down, right? Sure, I mean, it happens, but I would want to know where those lines are. Markets hit their pivot point 80% of the time. So far this morning, we have an MDP. That's a missed daily pivot. We haven't hit that pivot. The expectation is that we're going to hit it because that's what we do 80% of the time. Also, the distance from VWAP, we talked about how far away from the, not VWAP, the weekly pivot point, how far away we were from that. Well, we're not that far away again, which means we could try to expand back up because, well, there's room now to the ceiling. We're not pressing our head against it. We've got room to run back up to it. 5,700 on a close for today would not be a surprise. On the other hand, there's really no reason for us to do that, right? The banks didn't come out with some wow news, so we don't have that. PPI generally isn't big enough to give us something that sticks. We can get some shenanigans and some volatility like yesterday, that first initial move, 830 print, get the big move, and then the gap close setup. We had that same setup today with PPI, the potential for that same setup today. But that kind of move doesn't generally stick. So why would we go to 5,700 today, right? I say it's on the table, just from what? So if we turn all that off instead and just think about what we have this morning, this is a very narrow range, right? It's what we call a draw. Sounds funny. The thing about a draw is long and short traders can start building a position here because you don't know who's right and who's wrong. If you're short and you're building a position, theoretically, your stops are up here. If you're long and you're building a position, theoretically, your stops are down here. Everybody's happy to build their position here because they don't know that they're wrong yet. So this is just a great place for everybody to get in. And it draws in both sides because you could make an argument to go either direction at this point. So this is what we call a draw. The raid part of this, because it's a draw and a raid, is rating the liquidity. So say we're going to go back up to 5,700. What we'd expect first is to raid the liquidity on the downside. So come back down, test this low, break through it, get like a double bottom bear trap reversal, gather up all that liquidity, and then make our move to the upside into 5,700. On the other hand, if this is a raid and a draw to the downside, then we would expect a break above the current Globex high, get into that liquidity, gather up that liquidity in a raid, break the low, and then expand to the downside even lower. 5632 is a cog line. 5,600 or at least 5,611 would be the next target down, the next cog. If we can get through 11, then we'll just get to the roundy 5,600. It's not out of line. It's not even all that far away. 56.11, 56.14. That's really close together. So cog line, ADR half, and then 55.92 is a cog line. So that's the yellow line. It's the full ADR. That's some really clean pivot points. 32, 11, the roundy, and then 91. Level by level. Taking it the other way, then we've got 56.50. That'll be a level to get past. And then 62. Then the Globex low of yesterday. That's a pivot point worth noting. Somewhere around that 56.80. And then the ADR full. And then yesterday's RTH high. And then the round number. So we got some really good pivots to the upside as well. Add that round number in there. Now, we could always lay it out that way, but you can also measure the range that we have this morning and plot those levels also. That wouldn't be out of line. Still growing. $10-day, 30-minute volume profile. We're very close to the point of control shifting up to our new location. That would be that 56.42 area that I mentioned yesterday. It was already a done deal that this was going to become our new point of control. But I wasn't expecting it until next week. We might see it today. We're going to lose more volume off the bottom. At the same time, we're going to be building up more volume right where we are. So this very likely is going to shift by the open, and we'll be looking at the point of control, which is also at the value area high. So how that's going to play out, it's going to have to move, right? It'll very likely shift up into 56.60-ish. Yeah, probably right into this air pocket. So this yellow line will shift up here. Point of control will shift up here. And that will give us a volume profile with price right at the point of control. Notice the TPO, it's already there. That's the point of control for the TPO. It already made the move up, and the value area high, it didn't shift up very far. Generally, a B shape, capital B shape profile is really just two Ds. And we would be looking for the point of control because there's only one. We're going to see this point of control move up to the upper B or the upper D. It's considered bearish, really, but I wouldn't put it in that context because this is a 10-day. If it was a daily, that'd be different. This is a 10-day, and if we can hold above that pivot point, so we're going to expect it to come up. That'll be where price is. We can dip down below it, above it, you know, kind of crisscross it back and forth like price did back here. But it eventually got above it and held. Well, if this point of control comes up here and we get this same sort of behavior, but we can hold above it, we'll be looking for that drive above it as well. Right? That's why it's worth noting, where is it and is it going to move? Those VPOC lines that we've been marking out, we took one off yesterday. Price fell to the downside. It hit this VPOC. It was an area where we paused, consolidated. It's done. We don't need that line anymore, so we can take it off. We don't have a new VPOC to carry forward for today. because we've already hit that level multiple times. While it's not a VPOC at this point, it is still a POC. It's a point of control, right? The textbooks will tell you to carry forward this line. So you would put it in yesterday's price, carry it forward into today, and you would do that for the point of control, the value area low, and the value area high. I generally don't do that. I've already got enough pivot points that I don't need more pivot points. But every once in a while, it's worth kind of just taking a look. So what I'm doing here is changing it so I know my line at a glance. The VPOC lines are gold, so I'm changing it that way I don't get it mixed up, right? That's just a POC line, not a VPOC. I want to see how price responds at that level again. This is a classic P shape, excuse me, a B. I was thinking about the inverse of this. There's your classic lowercase b, and that's the D shape that we were talking about with the point of control. This is often looked at as a bearish bias by itself. These little D's back here are completely different. So we'll see the follow through on it. See if we're going to continue lower or not. Still think 56.32 cog line or yesterday's low, which is also really close to Wednesday's low and Tuesday's low, that this is just a really significant level, right? That 56.30. Holding that low today very likely gives us the stability to go back up. Remember, there's a lot of options levels down there. If we read spot gamma, right, and kind of consider all of their input, they haven't come out with their AM notes. Even now, this late, they still don't have the AM notes yet. So no insight from them. We're back below 4% on our distance from the weekly, the 10-week moving average. We're back to 3.5%, and that's the sweet spot. It's kind of where we want to be. I'd even take it a little lower. If we can get 3, somewhere between 2.75 and 3.25, that'd be perfect. So a little more fade, or if we just sit still, then that'd be all right. We have next week's range already getting projected. That's the way this indicator works. Just keep in mind, it's not set in stone yet. Next week's range won't be locked into place until 4:15 tonight. As the current price moves up and down, so will this gray line, which is marking current price, and so will the red and green lines. They're going to adjust higher and lower. As we get into the later part of the day, say 3:30, 3:45, you could look at SPX plays or ES and NASDAQ. That's your flavor. But you could look at some options plays for next week, seeing if we can pin on those levels, or because it's going to be OPEX, whatever we hear from Spot Gamma today about next week's OPEX levels, they usually give a plus and minus in where they think the ceiling is. It wouldn't hurt to put on some sort of double calendar or iron condor if you can get enough credit for it. Kind of play the ranges for next week. I kind of like the idea of a double calendar. If we're expecting to hold this range for OPEX, then should get some pretty decent money out of it. 15 minutes until PPI, so a little bit of heads up there. It's generally not worth looking at the things that are up or down in front of CPI and PPI. So we'll look, but all of this could flip very fast. Just like yesterday, how small caps and the New York Stock Exchange names just ripped higher, and we didn't see any of that in the pre-market, right? So doing this early in front of econ, I wouldn't expect much. We can see the VIX is down, and it says the 10-year is down, but Thinkorswim's been having issues with the 10-year, so I don't trust anything it says about the 10-year. Gold and gold miners are down, and the Mag 7 group is down again. Things that are up, China ADRs, and just plain old China itself. Home builders is up. Solar technology is up. And that's one that really gets affected by lower yields, right? I mean, they just really benefit from the falling dollar, falling yields. So if you're playing those long, those solar plays, keep your eye on TNX, or just bring up the 10-year, right? The 10-year futures. Because if we hit support and bounce in the 10-year and start making moves back up, those solars are going to get whacked again. If you want to know more about that, we can always dig into it at some other point. Banks are up, so the earnings must not have been completely horrible, which we knew they hit on some of those lines. But remember, it's not just their earnings, it's their forward guidance. And I haven't had a chance to parse out that guidance yet. I'm going to use AI on it. Again, I continue to encourage people, if you're not using AI to do anything, baby steps, right? Use it for something. The more you get familiar with using it, the better. And not that 4-year delayed chat GPT junk either. Find one that is using, today's data. Otherwise, it won't do you any good to review bank earnings if it's 4 years delayed. IBB is up. This was a really good breakout play. I gave a shout out yesterday on this. So here's IBB. We're on a daily chart. Kind of see that year and a half of just sideways, and then boom, right? So I guess it was just this year, 2024. And really, we set the high here in February. You can see the year-to-date anchored VWAP. Remember reciprocation? We talk about it with VWAP all the time. Measure the move from this highest point to this lowest point. Project that upward 50% and 100%. Also add the warning center and the 1, 2, 3, 6. This is the IBB levels to be concerned about. We're already above the warning center, so we need to keep it. The next area of resistance is 145.30, and then the halfway point, 145. Excuse me, 150. It's the halfway point. The final move is 158, but I would aim for 50%. That's a really nice breakout on biotechnology, which has been doing really good this year, right? I mean, or maybe it's just exposure, but I've seen a lot of biotechnology making moves this year, and I'm not used to so many bio names. Maybe it's exposure, right? You start to see it, and then you see it everywhere once somebody points it out. If we measure this entire range, which would be different than what we were doing, you can see we're at the 111 warning center. So that's a bit of a concern at this level. And 148.70, just call it 149, is the half, the 1, 2, 3, 6. We measure this entire thing. There's your half back, the level that we've been struggling against, and we're finally through the half back. So the 172, 175 area back up to these highs. I just really like IBB. This looks great. Just remember, it's not going to be a straight line, right? It's going to be a struggle. It very likely is going to look a lot like this. Just a lot of fighting and difficulty getting up to that level. So I wouldn't expect, you know, like this kind of move from here right up into that level. That'd be too much to ask for. We'll take it if we get it, right? But I wouldn't expect it. 8 minutes. So we got KRE, energy, oil and gas exploration stuff. So not things like crude by itself, more of the companies behind it. And then solar because of yields, home builders, also because of yields. I mean, that move in the 10-year yesterday is directly accountable to this. And if we get a bounce and get back above 4.2, say into 4.3, all this is going to just unwind. So approach with caution. That's why semis are low, but I mean, they are green. Muddy water, to be sure. Get past the econ this morning. Your afternoon is free and clear. Watch the clock. Be careful. Be safe. Have a good weekend. I'll see you all next week.